AT&T, stock ticker T, now trading near its 52-week low at $14.50 per share. Over the past year, it's down nearly 30%, and year to date, down almost 22.7%. Now, this gives the company a starting dividend yield very high, sitting at almost 7.7%. And we can see actually in the last 5 days, they've taken quite a tumble, down about 5.56%. And a large part of that is due to the fact that AT&T stumbled as JP Morgan downgraded them. If we scroll down just a little bit, we can see early trading on Friday, investment firm JP Morgan downgraded the telecom giant, citing worries over its wireless and broadband segments. And if we come over here, one of the things you'll see is we actually have their upcoming quarter's earnings getting ready to be released on July 26. Now, if we take a look at the latest quarter's earnings, we can see they actually beat on their earnings expectations slightly by 1 cent. But if we look at the top line revenue surprise, they actually missed by a little over $81 million. If we look at the expectation for the upcoming quarter's earnings, it's actually pretty similar to last quarter's as far as the earnings goes, and the revenue estimate pretty close to that of last quarter's, a little bit lower though. Now, a couple of things to look for in the upcoming earnings report. We can see that analysts are predicting a 1.1% year-over-year increase in revenue, going to $29.98 billion, and profits of 61 cents per share. Now, something I talked about in my last overview of AT&T stock is their free cash flow was a little bit lower than expected in Q1, but you can see they are still on track to meet or exceed its $16 billion free cash flow target for 2023. Now, the big problem with this company is if we jump into the balance sheet, one of the things you'll notice is they still have a massive amount of debt. I'll go ahead and scroll down. Remember, debt is going to be near the bottom, and we're going to find it on our long-term liabilities. And if we come over here, we can see at the end of December 2022, their long-term debt was a massive amount. That's definitely something that they need to reduce, or else that dividend will definitely be at risk. But with all of this being said, let's go ahead and jump into my stock valuation spreadsheet to see if we can find the intrinsic value of AT&T and decide if it's a stock we should consider buying or selling. We'll be looking at a few different valuation models like always. If you'd like to be able to download the spreadsheet, then you can head over to my Patreon page at the link in the description. Let's go ahead and come up here and plug in stock ticker T and hit enter, and again, you'll see all of this data will automatically load in. Now, around a few months ago, you can see they were trading pretty close to this low, but it's pretty much back at its 52-week low. That dividend payout sitting at $1.11 gives it a very high starting dividend yield, sitting at 7.66%. Now, let's go ahead and jump into that payout ratio. How safe is AT&T's dividend? And if I scroll down, if you've been keeping up with the stock for a while, they had a pretty good history of paying out large dividends and growing dividends for quite some time, but in 2022, they did cut that dividend by a pretty major amount. Since then, they've been steadily paying out 28 cents per share every single quarter. And one of the things you will notice is they've now gone 6 quarters without increasing that dividend payout. So that is interesting to see. To me, it does seem like they aren't interested in increasing their dividend payouts at the current time. Now, how safe is the dividend? If we come down here, we can see the cash dividend payout ratio now sitting at around 60%, but the payout ratio overall sitting at around 43.7%, and cash flow payout ratio sitting at around 20 to 22%. So that dividend cut did give them a lot more capital to work with and reinvest back into the business. But let's go ahead and jump back over to our spreadsheet. You can see analysts currently have a target price of around $20.27. Institutional ownership pretty low, only sitting at 54%, and a beta of just 0.66, so you will see less volatility with this company. But let's go ahead and jump into our first valuation, which is going to be Graham's valuation. Here's a formula he lays out for us to calculate intrinsic value. First, we need our earnings per share, and I'm looking at the forward-looking earnings per share in this scenario. Then we need to apply our growth rate projection. Now, analysts are projecting very low growth rates for this company. That's pretty much across the board. So I'm staying in line with those analyst projections, only projecting a growth rate of 1, and then we multiply that by 4.4, which is the average yield of AAA corporate bonds. Once we've done that, divide by Y, which is the current yield on AAA corporate bonds. And at the time of this video, it's sitting pretty high, which will drive down the valuation, sitting at 4.65. So when we apply all this into our formula, we come to an intrinsic value of $18.39. Now, the next valuation model we'll look at is our discounted cash flow analysis. Now, this is kind of a unique DCF model because most of their historical data is actually not applicable here since they had the spinoff with Warner Media. But what we do know is they are now projected to slightly beat their free cash flow estimate for 2023 of a little over $16 billion. So I'm sticking with that estimate and projecting a 2.5% free cash flow growth rate to the future free cash flows and to the terminal value, which is the sum of the future free cash flow past the year 2030 in this scenario. I then found the present value of those future free cash flows and added them together, add the company's cash and cash equivalents, and subtracted out their total debt, which, like I mentioned earlier, is a massive amount. But that gives us the equity value. We then divide by shares outstanding, and we come to a discounted cash flow price per share of $15.74. cents. Now, the next valuation I typically look at is the multiples valuation, but really the only good comparable in my opinion to AT&T is Verizon, and if you only have one comparable, it really doesn't provide a fair valuation, so I'm not using it in this scenario. But one thing I will point out is AT&T does have a very low price to earnings. You can see it's only sitting at around 5.71, forward looking around 5.97, so that is pretty low, but some people would argue that's justified due to the low growth rate projections. But let's go ahead and jump into our last valuation, which is our dividend discount model. And basically this is a way to value a company based on how much they pay out in dividends and how much that dividend is increasing over time. And you can see I actually haven't plugged in the historical dividends here because we had that dividend cut, but moving forward they are hoping to slowly increase that dividend. Now that's not something they're currently working towards, but I think it is possible if they can get to that 2.5% free cash flow growth rate like we saw in the DCF. So I am projecting a growth rate to their dividends of 1.25%, so a very slow but steadily growing dividend with a discount rate of 8.5%. The dividend discount model gives us a price per share of $15.53. Now keep in mind, anytime you have a dividend growth rate only sitting at around 1.25%, assuming that inflation is around 2, 3, or 4% long term, they'll technically be paying out less in dividends year over year due to the fact their growth rate is lower than the rate of inflation. So that is something to take note of when looking at potential dividend growth investments. But when we jump over to our output tab, we can see our three valuations. We have grams at $18.39, DCF at $15.74, and dividend discount model at $15.53. So when we average all three of these together, we come to an intrinsic value of $16.56. Current trading price currently sitting at around $14.50. So with a 10% margin of safety, you can see it actually is within our acceptable buy range. With a 20% margin of safety, it's still not in our acceptable buy range, with the acceptable buy price sitting at around $13.24. So at its current prices, I actually do think the company may be slightly undervalued, but with that being said, this company doesn't really excite me because the growth rate projections are so low. We see slow earnings growth, slow free cash flow growth, and slow dividend growth. For me personally, I want to be able to buy companies that I can feel comfortable holding long term, that I think will have good growth rates and will be able to continue to grow their dividend payouts over time. So for me, I'm not really interested in AT&T despite the high starting dividend yield and the slight undervaluation. But there you go, there's a quick analysis on AT&T. I will be interested to see what happens in their upcoming earnings report. But if you'd like to be able to download the spreadsheet, then you can head over to my Patreon page at the link in the description. So that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.